you're not so much in love with the way that the business has been progressing.
Well, I mean, love is an emotion. We try to be mathematical about it. Like with a 5.47 Triton score, it wasn't really sort of a question of what was going to happen here, but when. Right? And so, for example, I didn't even get uptown in time to stop it, to say, like, it's going to start coming off before it fell below 80. And what we see happening is, again, there's a lot of excitement about this deal, but there's a lot of problems with the fundamentals of the company, and time will give people an opportunity to look deeper into that and may not be so friendly about it.
But just looking at today, pretty you'd say there's a fairly mediocre.
No, they raised $2.3 billion.
So that's good.
That's good, right? Because
then people who bought this morning are already looking at some losses.
Correct. But if you're a hedge fund and you bought it, at 72, then already you're wondering, like, when do I need to get out of this thing, or else I have to book the loss.
So, I mean, a lot of the analysts who sort of came out ahead of this and sort of with their own sort of stock ratings, even before the stock actually existed.
Yes.
Their sort of thesis seemed to be that don't worry about the fundamentals right now. There's sort of a broader growth theme here. There's sort of the disruptive thing that we've heard many times before with tech companies. Why shouldn't we buy into that? Because, I mean, they are doing something that, at least in some corners, could be considered innovative.
So I think you could be very bullish about the long-term theme of ride-hailing and still have questions about the value here and the fundamentals here. So these guys spend $2 a ride just in marketing and incentives, right? And they spend another $2 a ride in insurance and another 50 cents in operations. So you're at $4.50 a ride right there today, and so they need to spend to grow. They spent $1 billion last year. They only raised $2 billion now, right? So is it going to be growth or is it going to be profitability? We're already in a zone where it's going to be a choice.
And what would be the right choice, do you think, considering that
other than giving all the money back?
Well, in terms of the choice, in terms of growth versus profitability, because they still have ultimate control over the company as founders. Very little of this share of the actual company is freely traded right now. Hardly any of it went into the market.
So no one can get any borrow. The short side is going to be going crazy about this. So what should they do? Well,
do you think they should sacrifice growth?
They don't exist in isolation. So we're going to see an Uber filing in 2 weeks, less than a month, and then Uber is going to raise $20 billion to compete with them in the market. And I think they're going to have their hands full reacting to whatever Uber decides to do because Uber is the big dog in this market.
But talk about some of these other companies that are coming to the market, because when you look at the Triton score, I mean, you rated this below Snap.
Which you don't see that every day.
Right, you don't see that every day. And we saw, of course, what happened to Snap. But there was still an appetite, at least in those first few months, for Snap shares. Obviously, that faded for a variety of reasons. And you've got this whole host of companies, Airbnb, Pinterest, Postmates, they're all lining up here. And my guess is that some of your scores in those companies probably aren't terribly better.
I mean, if you were going to pick the one that we're thinking might be the new low is WeWork. This company today goes public. It had a $15 billion valuation.
Is it a tech company or a real estate company?
Right. Well, I mean, again, it's like the one number you could believe about Lyft is the $1 billion of negative EBITDA, and WeWork has twice that, but 3 times the valuation. Right. So that sets it up for a problematic dynamic between
WeWork's losses are bigger than the revenue, right?
It's about this 2 and 2, roughly.
You don't see that very much, do you?
It's really, you got to take your hat off to these guys because almost no one can raise enough money to lose so much money.
And what's amazing is this brilliant story out in the UK from one of our reporters showing that European banks are actually not wanting to finance or indeed continue to finance WeWork because they're worried about getting so exposed to one particular company.
So what's great about that is the bankers that won't finance to let WeWork sign the lease assume that you'll get all the way through the equity before they're actually exposed to the lease on the fixed income side, right? So to say, like, we're not comfortable signing leases with these guys, even though they've raised tens of billions of dollars, tells you a lot about the different view of the equity-oriented world versus more of a real estate fixed income view.
Do you take a view, we were talking about this with the last guest, of what it says that, I guess WeWork is worth $45 billion and Lyft was able to raise over $2 billion. Is there any sort of cyclical element? Because people have been talking about this for a while that, well, this must tell us something. But then I will look at past IPOs and people worry about bubbles in those times too.
Sure.
So is there any broader macro lesson from this, or is it just happens in the world of IPOs?
I think what you can say about these companies is whether or not they make money, they're not very profitable, but they grow. And so investors like to invest in growth companies. That's something people used to be able to do in the public market. Now it's very hard to do that. So if you're going to invest in early stage or middle stage growth companies, you want to do that privately, which is why now Fidelity and BlackRock and all these guys, not to mention SoftBank, do it to such a great extent.
You told us your worst one. What's your best one in terms of the one that's going to come?
Oh, the one that's coming, it's difficult to say. Like, Like we said that Lyft was sort of reminded us of Snap. We said that until we saw Pinterest, which reminds us a lot of Snap. It's kind of exactly the same business. They just don't have the same loss profile. So think of Pinterest as sort of a premium to Snap. You know, again, we look at them when they come is my dodge on this question. Like, well, I'll let you know if we see anything that we really like, because, I mean, on average, scores for the trailing year have been like just over 6 versus 6.35 average overall. So in general, we're seeing quality degrade at the scores.